Have you ever wondered about the difference between cash flow investing and capital gains investing? Let me take you on a journey back to when I was 16 years old. My friend's father, who I affectionately refer to as Rich Dad, decided to take us on an enlightening visit to a cattle ranch. Ah, the ranch, a sprawling expanse of grassland, dotted with cattle and the occasional cowboy, a truly mesmerizing sight. On this particular visit, we had the chance to observe the cowboys as they expertly herded the cattle from the feed yard, guiding them towards the slaughterhouse. The air was thick with an unspoken understanding of what was to occur, the cattle seemingly aware of their impending fate. It was a poignant experience, one that has stayed with me to this day. Fast forward a few months and Rich Dad took us to a dairy farm. The scene was quite different. The farmer would herd his cows into the barn for milking early in the morning. The cattle seemed content, their behavior contrasting starkly with that of the cattle at the ranch. Rich Dad used these two experiences to teach us a valuable financial lesson. He explained that both the cattle rancher and the dairy farmer counted their cattle as assets. However, the way they treated these assets and the business models they operated under were starkly different. The cattle rancher, he said, could be likened to an investor who invests for capital gains. This rancher would always be on the lookout for new cows to raise, a never-ending cycle of search and slaughter. This, dear listeners, is akin to the cycle of buying and selling in the world of capital gains investing. So, you see the cattle rancher's constant search for new cows, that's capital gains investing for you. But what about the dairy farmer? Well, that's a story for the next scene. Stay tuned as we delve deeper into the world of investing, using a herd of cows as our guide. A few months later, we visited a dairy farm. The sun was just starting to peek over the horizon, casting a warm glow on the dew-kissed grass. As we stepped out of the vehicle, we were greeted by the telltale signs of farm life. There was a palpable sense of routine, a rhythm that the farmer and his cows had established over years of working together. Early in the morning, we saw the farmer herding his cows into the barn for milking. The cows, each with a knowing look in their eyes, moved with purpose. Unlike the cattle we'd seen at the ranch, these cows weren't heading towards an impending end, but rather, towards the start of another productive day. The dairy farmer, clad in his worn-out overalls and rubber boots, moved with a quiet confidence. He knew his cows, their temperaments, their habits, and their quirks. He had a unique relationship with them, a relationship built on mutual respect and understanding. These cows were not just assets to him, they were partners in his business. And that's when it clicked. The dairy farmer's method of operation was akin to a cash flow investor. He didn't need to constantly find and raise new cows like the cattle rancher. Instead, he maintained his existing cows, ensuring they were healthy, comfortable, and productive. This was his business model, his strategy, and it was starkly different from the cattle ranchers. In the world of investing, the dairy farmer's approach mirrors that of a cash flow investor. The cash flow investor doesn't chase after new investments all the time. Instead, they focus on maintaining and nurturing the investments they already have, ensuring they continue to provide a steady stream of income. They don't kill off their investments, they milk them. And that's the beauty of cash flow investing. It's not about constant hunting, it's about careful nurturing. It's not about the thrill of the chase, it's about the satisfaction of consistent returns. It's not about the short-term gains, it's about the long-term stability. The dairy farmer's strategy of maintaining his cows, that's cash flow investing. It's about making your investments work for you, consistently and reliably, just like a dairy cow providing milk day after day. The cattle rancher and the dairy farmer, two different business models. With a closer look, we start to understand the subtle yet powerful differences between these two models, the cattle rancher and the dairy farmer. Or, put into an investing perspective, capital gains investing and cash flow investing. Consider the cattle rancher, the epitome of capital gains investing. His business thrives on the constant cycle of raising and selling cattle. It's a continuous grind, always on the lookout for the next cow to raise, the next investment to make. The rancher's profit? It's the capital gain, the difference between the buying price and the selling price of the cow. The bigger the difference, the larger the profit. But the moment he stops buying and selling, his income stream dries up. It's a bit like those who invest in stocks or real estate, hoping for the value to increase over time. They buy low, sell high, and repeat. On the other side of the field, we have the dairy farmer. His strategy mirrors cash flow investing. The dairy farmer's focus is not on the constant buying and selling of cows, but rather on maintaining and milking the cows he already has. His income doesn't rely on the fluctuating market prices of cows, but on the steady, reliable stream of milk they produce. The dairy farmer doesn't need to worry about finding new cows to buy, he just needs to keep his current cows healthy and productive. It's much like those who invest in dividend-yielding stocks or rental properties. They're not primarily concerned with selling their assets at a higher price, but with the regular income these assets generate. In the world of investing, these two strategies couldn't be more different. One chases the fleeting promise of high returns through buying and selling. The other seeks the steady rhythm of regular income through maintaining and milking. Both can lead to wealth, but they demand different levels of effort, risk, and patience. Two different strategies, two different results. Why do so many people lose money investing? This question echoes in the minds of many, and the answer, ironically, is hidden within the herd of cows we've been talking about. Picture this. You're a cattle rancher, always on the lookout for the next big herd, the next potential profit. You invest your time, energy, and money into raising these cattle, only to sell them off for a one-time gain. This is akin to the mindset of those who invest for capital gains. They buy an asset, hoping its value will increase over time, and then sell it off, aiming for that one big payday. There's a thrill to it, no doubt. The anticipation of the sale, the potential for enormous profit, it's alluring, but it's also risky. Like the cattle rancher, these investors are always on the hunt for the next investment, the next opportunity for a big payout. They're constantly in a cycle of buying and selling, and with each transaction, they expose themselves to the volatility of the market. Now let's consider another scenario. You're a dairy farmer. Your focus isn't on the one-time sale of your cows, but rather on the consistent, reliable production of milk. This is the mindset of those who invest for cash flow. They invest in assets that generate a steady income over time, such as rental properties or dividend-paying stocks. Unlike the cattle rancher, the dairy farmer doesn't need to continuously seek out new cows. They simply maintain the ones they have, ensuring they're healthy and productive. Similarly, cash flow investors aren't constantly buying and selling. They're holding on to their assets, nurturing them, and reaping the benefits over time. The pitfall, then, lies in the allure of quick, significant gains. It's tempting to be a cattle rancher in the world of investing, but it's also fraught with risk and constant labor. Investing for capital gains, while attractive, carries far more risk and is more labor-intensive. So, the next time you're making an investment decision, ask yourself, do you want to be a cattle rancher or a dairy farmer? So what's the better strategy, you may ask? Well, let's take a page from the dairy farmer's book. Investing for cash flow is akin to milking your assets instead of slaughtering them. It's about focusing on maintaining and growing what you already have. Picture this. A dairy farmer doesn't have to incessantly buy new cows to keep his business afloat. Instead, he takes care of the herd he has, ensuring they are healthy and well-fed. The result? A consistent supply of milk, which translates to a steady flow of income. Now let's apply this to the world of investing. Imagine you've invested in a company's stock. Instead of constantly buying and selling, hoping for a large capital gain, you hold on to the stock, reaping the benefits of dividends over time. This is the essence of cash flow investing. Moreover, this approach isn't just about the money, it's also about peace of mind. Cash flow investing provides a level of predictability and stability that capital gains investing often can't match. It's the difference between a roller coaster ride and a steady cruise. But wait, there's more. Cash flow investing also offers the potential for growth. As you reinvest your earnings, your assets can compound over time. It's like the dairy farmer who uses some of his milk to make cheese, which he can sell for a higher price. The result? His income stream grows. In the end, both strategies have their places. Capital gains investing can offer large returns, but with higher risk and volatility. Cash flow investing, on the other hand, may not have the same level of excitement, but it offers a steady, predictable income stream. It's the slow and steady approach that often wins the race. So, to answer the question, the better strategy depends on your financial goals and risk tolerance. But remember, investing for cash flow, while it may not seem as glamorous, can lead to a steady stream of income, just like the dairy farmer's milk.